Well, interest rates, of course, hitting more than crypto, with housing also feeling the bite. But while a slowdown there could indicate recession, markets may not reflect the reality yet. Here with more, Jeff Schulze, investment strategist at ClearBridge Investments. Good to have you on the show, Jeff. So I want to ask you, in terms of what we're seeing now, we know that there were this counter trend rally that we saw from markets, didn't really want to listen to what the Fed was saying, or perhaps just honing in on what they wanted to hear. But where are we now after this week of hotter than expected inflation data?
Well, I think we're clearly at the bias for upside for rate hikes as we look forward. If it was just one data point in isolation, the Fed could look through that. But there's been a myriad of data points that shows that not only the economy is not weakening, but it may be accelerating at this point. Obviously, starting with payrolls and non-manufacturing PMI and moving over to retail sales and the CPI and PPI reports earlier this week. So obviously, you've seen Fed fund futures price in about 3 rate hikes over the next couple of FOMC meetings. And I think the bias is to the upside if this pulse of acceleration that we're seeing really is genuine.
And so a lot of people wondering what that means, perhaps seeing that extra rate hike. We know that that's what Goldman Sachs was saying, perhaps another 25 basis point rate hike. But we hear a lot about no landing, soft landing, but we're hearing a lot more about no landing. And Jeff, our morning brief today covered that disconnect between what we saw with strong earnings and what we're seeing here. What is your take on this?
Well, we've had a lot of narratives this year. It started off as a recession was a foregone conclusion. Then it was soft landing. Now the Fed's behind the curve. So things have changed rapidly over the last month and a half. But in thinking about market price action, it's really been driven by sentiment, right? The fundamental picture from the earnings backdrop that we got has not been pretty, right? The number of companies beating expectations is about 70%, well below that 5-year average. The year-over-year earnings print expectations just moved into negative territory. The last 4 times that you've seen this dynamic take place, you've really seen an acceleration to the downside for equities. And you've seen broad-based margin deterioration with operating earnings down about 150 basis points, and that's usually recessionary territory. So while the markets have hung in there over the course of the last 2 months and through this earnings season, I think when reality ultimately comes to bite, which is a U.S. recession in the back half of this year, I think the markets are going to price that. But we haven't seen it quite yet.
And as we talk about some of these signals, we know that your recession risk dashboard focuses on housing permits as one of the indicators. What is that signaling right now?
Well, housing permits just went to a red signal. So we have 12 economic signals in our proprietary dashboard. At the moment, we now have 9 red signals, but this turned to an overall red signal back in August. So our base case has been a recession for over half a year. And given all the rate hikes that the Fed has done and will continue to do this year, we think a recession is a very strong possibility. And I know that we got the LEI numbers this morning and the markets rallied after getting it. But the LEIs are down for the 11th consecutive month, right? Usually when you go down 4 months in a row, you're in that recessionary danger zone. Clearly through that threshold and looking at it from a different vantage point, the LEIs are down 5.9% on a year-over-year basis. The largest drop that you saw prior to a recession was 5.7% ahead of 1980s downturn. So even with this, a reacceleration of activity that we're seeing, we think that the economic cake is baked for the U.S. economy, and the more hikes that we're seeing now is going to deepen the inevitable downturn that we're anticipating.
And speaking of hikes, I know that you said that you're expecting the threat of interest rate hikes to be relatively muted when it comes to mortgage rates. We did see them climb higher consecutively over the past 2 weeks to 6.32%, and that came off the heels of 4 weeks of declines. But why are you expecting it to be relatively muted?
Well, I think a lot of the pain has already been felt in the mortgage market. You've obviously seen an impulse of positive housing activity with the NAHB bouncing this week pretty considerably to 42. Mortgage applications bounced as well. But I think more importantly, you have a housing market that's in a much better position than what we saw just 15 years ago, right? You don't have people who are overextended. A vast majority of mortgages that have been originated here recently are super prime borrowers, not subprime. And I think when you think about the mortgage market overall, it's not uncommon to see a bounce as you get towards the end of a tightening cycle. So if the Fed does another 50 or 75 basis points of tightening, that's already reflected in mortgage rates at the moment. And clearly what we're seeing right now is that there's a little bit of pent up demand for housing, which is why we've seen the bounce here.
And I also want to talk layoffs because obviously we have seen layoffs mostly still concentrated in the tech sector, not really seeing that as much in the broader economy. But we are continuing to see these announcements. And you're saying that we should be having a look at the home builder sentiment as perhaps a foresight of what we can expect in terms of layoffs for 2023. What is that showing you?
Yeah, so obviously a lot of the layoffs have been larger companies, big tech in particular, but I think a lot of people forget that these companies have been feasting at the trough of labor over the last couple of years. Really, if you look at all of the excess labor demand, it's coming from small businesses. The increase of job openings today versus prior to the pandemic, about 90% of them have been from companies that have less than 250 employees. Even though they only make up 45% of the labor share. So this is really a small business story. But if you think about looking out over the next 6 to 9 months, the ability to raise prices is dropping dramatically per the NFIB small business survey. And the number of companies looking to raise compensation is remaining steady. So there's being margin pressure being illustrated in small businesses. And we think it's only a matter of time before that results to a full-scale layoff cycle. Now, coming back to your question, how does the NAHB survey from home builders relate to the unemployment rate? It usually leads the unemployment rate by 12 months. And even though we have seen a bounce in the NAHB, this would suggest an unemployment rate, if this relationship holds true, north of 6% if we look out on the horizon.
Certainly worth keeping in mind because we're not hearing too many people talking about that. Jeff Schulze, thank you so much. Investment strategist at ClearBridge Investments. Thank you for your time this morning.